C corporations don't get special capital gain rates. A capital gain is taxed at the same corporate rate as ordinary income. The big trap is on the loss side. A C Corp can deduct capital losses only to the extent of capital gains. So if the corporation has a net capital loss for the year, it can't use that loss to reduce operating income on the return. On the EA exam, they love the phrase, no offset against ordinary income. If a C Corp has a $30,000 net capital loss and $200,000 of ordinary taxable income, the capital loss deduction is still zero for that year. Instead, you move the loss to other years using the carryback and carry-forward rules. That's the only way it becomes usable. Here's the ordering rule. A net capital loss carries back 3 years first, then carries forward 5 years, and the carryback is applied to the earliest year first. 3 years back, then 2, then 1. You're basically hunting for capital gains in those years to absorb the loss. Any leftover after the 3-year carryback becomes a carry forward you can use for up to 5 future years. One more twist. When a corporation carries a capital loss to another year, it's treated as a short-term capital loss in that other year. That matters because short-term losses offset short-term gains first, then long-term gains. Exam tip: if they give you a long-term loss in the loss year, don't assume it stays long-term when carried. It flips to short-term in the carry year. Also watch for an S corporation history. A C corporation cannot carry back capital losses to a year when it was an S corporation. So if the company converted from S to C this year and has a net capital loss, the carryback window is effectively blocked. The loss will generally be carried forward instead, still treated as short-term in the future year. Finally, the expiration rule is harsh. If a net capital loss isn't used after the full 3-year carryback and 5-year carry-forward period, it disappears. It doesn't become an NOL, it doesn't roll forever, it's just gone. So on problems, after you apply the loss to all available capital gains in the allowed years, any remaining balance is forfeited. Cedar Ridge Partnership bought a rental duplex for $35,000. It made $10,000 of improvements and took $5,000 of depreciation. It sold the duplex for $50,000 cash, received property worth $10,000. The buyer paid $1,500 of real estate taxes and assumed an $8,500 mortgage. Cedar Ridge paid $2,000 of selling expenses. What's the taxable gain? Think about it. The gain is $28,000. Start with adjusted basis. $35,000 plus $10,000 improvements minus $5,000 depreciation equals $40,000. Amount realized is $50,000 cash plus $10,000 property plus $8,500 debt relief plus $1,500 taxes paid by buyer minus $2,000 selling expenses for $68,000. $68,000 minus $40,000 equals $28,000. The tempting miss is forgetting the mortgage assumed. Hawthorne Advisory is a C corporation. In 2023, it has $100,000 of capital losses and $50,000 of capital gains. Prior year capital gains were 2019, $20,000, 2020, $0, 2021, $24,000, 2022, $9,000. What is the capital loss carry forward to 2024? Think about it. The carry forward to 2024 is $17,000. The 2023 net capital loss is $50,000 because $100,000 losses minus $50,000 gains. Carry it back 3 years. Earliest first, 2020 has nothing. 2021 absorbs $24,000 and 2022 absorbs $9,000. That uses $33,000 total, leaving $17,000 to carry forward to 2024. A common wrong choice is $50,000, ignoring the carryback rule.